Alright, this is just amazing. Topic 2, financial statements. So I hope topic 1, which was the Excel workings, is very clear to you. Now let's go on to a very lighter note and see the basics that we would require to build financial models or to work on valuations. Not technicalities to those, but actually what are financial statements, because we'll be making financial models from the historical financial statements. We'll be talking about financial statements a lot during the course, all right? So it's very important at this stage to understand what actually are financial statements, how many types of financial statements are there, how do we present those financial statements, what are the elements that are included in those financial statements. Now, I know some of you might be very well versed with actually what are financial statements and the topics of financial statements. But again, see, I have to bring every one of you at the same level, right? So I will be talking about the very basics that you will need in order to understand and build or work on a financial model. All right. So let's dive in, people. Financial statements, topic 2. So before we actually begin, it's important to understand what is finance. So we are talking about finance as a career, finance as a field. So what is finance? What do you actually mean when you talk about finance? All right. So finance is a broad term. Finance is a very wide term that describes two related activities. All right. So two related activities. First is the study of how the money is managed and the actual process of acquiring the needed funds. All right. So what do we infer for this is that finance, if I just talk about finance, it is a broad field that basically includes two activities. Now, in order to work with money, it is very important to first acquire money. Only then you can utilize that money. So, acquiring the money, you need to get the money, you need to source the money to utilize them to your advantage. And the second is, after you acquire the money, you utilize that money. If I say you utilize money, I would probably want to say that once you get the money into the business, you see where to invest that money in order to earn the maximum return, right? So whenever you get, or whenever a business gets the money, he has to see whether and where to invest that money, into which alternatives, into which projects, into expansion, into capital expenditure, etc. That comes the utilization of that money. So these two processes are what finance is all about. And mostly the companies have a separate department, the finance department, which has two distinct functions to perform. Of course, managing the company's financial resources, what we just talked about, and recording and reporting all financial transactions. So if you acquire the money, if you get the money into the business, or if you utilize that money, if you are sending the money out of the business, how will you record those items? How will you keep a record, which is basically accounting? All right. So that's what finance is about. Moving on. Coming to the actual topic for the day, financial statements. Now, financial statements, we know every company has to prepare its financial statements. Financial statements comprise of what is commonly known as, we know that, a balance sheet, income statement, statement of cash flows, statement of changes in equity, and notes to financial statements. We'll be dealing with individually what do we mean by each and every statement moving forward. Right now, let's restrict ourselves to the broad concept of financial statements. So if I say that every company has to prepare its financial statements, which include the balance sheet, the income statement, cash flows, changes in equity, notes to financial statements. Now, my question to you is, who do you think prepares those financial statements? Is it the management that prepares the financial statements? Or is it the auditors who prepare the financial statements? Who do you think prepares those financial statements? Who makes the financial statements? Any guesses, guys? That's a very, very basic question, guys. Very basic question to ask. Financial statements are always prepared by the management of a company. They are never prepared by the auditors. So, preparing the financial statements is the responsibility of the management. Okay, it is the responsibility of management. Auditor audits those financial statements. He reviews those financial statements to see whether everything is going as per the standard or not. All right, so this is not an audit class. Okay, so you just have to know that the financial statements are prepared by the management. And what do they reflect? What do we infer from those financial statements? Financial statements reflect the financial performance or financial position of the company. So, by financial performance, what do I mean? Financial performance means the profits or loss that I have incurred while for an accounting period, right? Financial position, as on date, what is my position? What is the status of my assets? What are my obligations? What is my equity? All right, so all these components are reflected by financial statements. All righty, moving on. So income statement primarily has two components, the revenue and the expenses. Balance sheets primarily has three components, assets, liabilities, and net worth. And to know the position of cash, we prepare a cash flow statement. All right, so that's how the financial statements are interlinked. How are they interlinked? We will get to the practical applications of the financial statements when we take on a case study for that. But now I would like to mention here that income statement has revenues and expenses. So revenue minus expenses, income statement will give you profit or net income. That net income is the starting point for the cash flow statement. Alright, so that is how profit goes to the cash flow statement. And through cash flow statement, we find out the ending cash balance. That ending cash balance, this ending cash balance goes to the balance sheet in the form of cash and cash equivalents, and hence your balance sheet matches. So that's how the statements are interlinked. So some components, some other components of income statement also goes on to the cash flow statement. Some components of balance sheet also goes on to the cash flow statement to arrive at the ending cash balance. We will see when we will cover cash flow statement. All right. Okay. Moving on. Let's begin with the income statement or the statement of profit or loss. Okay, nice charts over here. An income statement reports a company's financial performance. This is important. Company's financial performance over a specific accounting period. Very, very important. Financial statement or the income statement, the first component of financial statement, the income statement reports a company's financial performance over a specific accounting period. What do you mean by a specific accounting period? That means if you are preparing the accounts from, let's say, 1st of April of a year to 31st March of the next year, which is Indian financial year. So if you are preparing the financial statements for a particular period, April to March, then the results, the profit, how you have performed throughout the year will be reflected in the income statement. Alright, so specific accounting period. It is for a particular period. So it includes the income generated from the business, which is known as the revenue. It also has the cost that you incur to generate the revenue. You will keep some stuff, salaries. You might have to pay rent of a building that you are working in. So all those costs which help you generate the income are your expenses. So revenue minus expenses will give you profit or loss, which are nothing but the returns that you have generated while working throughout the year. What is the end result? Are you in profit? Are your revenues more than the expenses? Are your expenses more than the revenue? Are you in loss? So all this is reflected by income statement. That is how an income statement looks like. We have revenue from operations, which is your basically the main activities, the core activities that your business is in. Alright, so it might be sale of products. Then we have other income. Basically, these are your direct incomes. These are your indirect incomes. For example, you might have received rent received, interest received. Those income that are related indirectly to your business, that are not your core business operations, are reflected in other income. Alright, so revenue from operations and other income. Then you have some expenses. Cost of the materials that you consume, the purchases that you make, the changes in inventory of finished goods, work in progress, and stock in trade. So this is nothing but your COGS, that is the cost of your goods, cost of goods sold. Employee benefits expense, these are salaries. Finance costs are your interest charges or the bank charges. Depreciation and amortization. So depreciation is basically when you have fixed assets. So when you purchase fixed assets into the business, now you use these fixed assets to generate revenue. Correct? Now if you are using the fixed assets to generate the revenue, then there is a principle of accounting, basically the matching principle. It says that you have to match the revenues with relevant costs. So if you are using those fixed assets to generate revenue, then what is the cost element involved? Because if you are using something, right, if you're using something to generate revenue, then you also have to attach cost element to it. The cost of using those assets. Yes. So what is the appropriate cost element? It is your depreciation. What is depreciation? Basically, when you are using fixed assets into the business, then those fixed assets, you have to reduce the cost of those fixed assets, basically due to wear and tear, usage, a flux of time. So the cost reduces, right? So that is the depreciation. Broadly, I am not going into the technical definitions, guys. I am explaining everything on a very, very broad level so that everyone is at the same page. Those who already know these concepts, please bear with me on this topic. Those who don't, whatever I am explaining is sufficient to make financial models or during valuations. Okay, so depreciation. Now there is a difference between depreciation and amortization. Okay, so if it's a tangible assets, if the assets are tangible, that means you can touch those assets, all right, those have depreciation. If the assets are intangible, what are the examples of tangible assets? Machinery, your furniture, computers, etc. And intangible assets, trademarks, copyrights, patents, goodwill, right? So those have amortization. Okay, so same concept, reducing the cost, right? But two different terms: depreciation for tangible assets, amortization for intangible assets. Okay, so total revenues minus expenses, you get your profit or loss. Now, when we report it in an income statement, you might be seeing this kind of a line: profit or loss before exceptional and extraordinary items and tax. Okay, that means the non-operating items or one-time items, one-time charges. For example, there might be some loss by fire, which is one time, right? Those will be your exceptional items. These are not on a regular basis. So you adjust those items, you arrive at profit and loss before tax, you subtract the tax element, you receive profit or loss from the continuing operations. Do not go into this term continuing operations. That's again technical. Continuing operations and discontinued operations. You don't need to be aware about that as of now. So profit and loss from operations, all right? Profit and loss from operations. So that's how an income statement works. Now, I wanted to explain two terms here. I'll just go back to the previous slide once. Alright, so revenue is also known as top line. So if you are working in finance industries, if you're working in finance department, you are working in investment banking department, you might be hearing this a lot. What is the top line of the client? So top line is the revenue. What is the bottom line? It's the profit. So top line and bottom line. All right. So top line, bottom line. Perfect. So that was income statement. Moving on. That's how we will prepare income statement when we are working for our financial models and valuations. So this one was according to the guidelines, according to the framework of accounting standards. This is how we generalize the income statement to prepare for financial models or valuations. So you will have revenue from operations, subtract cost of goods sold. So revenue minus COGS, what do we get? We get gross profit. I hope you know that, guys. Please, I hope that you know it. So from the gross profit or from the gross margin, you subtract selling, general and admin expenses. So all the expenses, be it salaries, be it office expenses, be it rent, be it any kind of traveling expenses, marketing, advertising, meals, fuel, everything is subtracted here and you get something known as EBITDA. Very, very important term and widely used term in corporate finance. EBITDA. EBITDA is your earnings before interest, tax, depreciation and amortization. EBITDA. Then from this EBITDA, you subtract depreciation and amortization and you arrive at EBIT. Okay? You arrive at earnings before interest and tax. You subtract interest, you arrive at profit before tax. You subtract taxes, you arrive at the net income or profit after tax. Again, this is my bottom line. This is my top line. Okay, so that's how an income statement looks like. Perfect. The next one is the balance sheet or the statement of financial position. Now, a balance sheet is an itemized statement that summarizes the assets and liabilities. So, what are the assets that a company owns? What are the obligations of the company? That is known as your financial position. What is the financial position of a business? And mind it, guys, this balance sheet is not for the period, not for the accounting period. Like income statement was for the accounting period, April to March. Balance sheet is always for a given date. You prepare the financial position, you prepare the balance sheet as on only one date, as of today, or at a certain date in time, not for a period. Okay? Alright, so the balance sheet shows, oh, this is wrong. An income, it was written income statement. A balance sheet shows okay, it shows the assets. Now, what are the assets? It is an economic resource that a company owns. Asset is what? The company owns with the expectation that it will provide a future benefit. Alright, so asset is something that a company owns with the expectation that it will lead to future economic benefits. What are liabilities? Liabilities are defined as the legal financial debts or the obligations that arise during the course of business. You might have taken a bank loan for running the operations of a business. Now, if you take the loan from a bank, you have to repay that. Well, that is obvious, right? Nobody gives you the money without the repayment. So, if you take the bank loan, you have an obligation to repay that. Okay? So, that is your liability. Your creditors, if you have not paid your creditors as on that date, as on the date of balance sheet, that means you have an obligation to pay your creditors. Hence, it again becomes your liabilities. Okay? And the third component is equity. Equity is what the people invest in your company. Alright? Basically, the share capital. You might have taken, people might have subscribed to the shares of your company. That is the equity component. Okay, so asset, liabilities, equity, and yes, a balance sheet always balances total liabilities. Total liabilities will always be equal to total assets. All right, so hence the term balance sheet actually. Okay, so what is the equation? So assets will be equal to your liabilities plus equity plus reserves and surplus. Fair enough. Moving on. That is how a balance sheet looks like, guys. You have the shareholders funds. Yes, this is according to the guidelines. Okay, so you have share capital, you have reserves and surplus, you have money received against share warrants. Okay, so this is your shareholder funds. Then you have non-current liabilities. Non-current liabilities. So liabilities or assets is divided into two categories: non-current and current. Basically, what is the difference? If you expect to pay back your creditors, or not creditors but the bank loan, if you expect to pay back the bank loan, let's say after a period of 12 months, then you have to show it under non-current portion. Non-current means which is not expected to be settled within 1 year, within 12 months. And if you expect to pay back the bank loan within 12 months, then that will be shown under current. All right, hence the difference, current and non-current. Okay, so yes, current asset, non-current liabilities, current liabilities, then non-current assets, your fixed assets, investments, deferred tax, current assets, your working capital basically, current investments, inventories, debtors, cash component, and so on. Okay, so that was again like we did it in income statement, guys. This is as per the accounting standards, accounting framework. This is how we will use it uh, in our financial modeling and valuations. So you have equity and liabilities. Will make the equity component, will enter the liabilities, then assets and total assets. So again, liabilities will bifurcate into non-current and current. Assets again will be bifurcated into current and non-current. Okay, cool. So we've covered two: P&L, balance sheet. Now is the third one, cash flow statement. What do you understand by cash flow statement? When you read the term cash flow statement, what comes to your mind? Well, as the name suggests, it shows the flow of cash within the company, right? So it reflects the inflows and outflows of cash. In other words, it reflects how the cash is generated in the company and how the cash that is generated is utilized by the company. And the cash flow statement ends with showing that what is the ending balance of cash and cash equivalents at the end of the period. All right, so it shows three things. First, how a cash is generated, then utilization of the generated cash, and ending balance of cash and cash equivalents. Okay, two important points here that you need to know while working on cash flow statement, guys. Whenever you see an increase in current assets, that is your cash outflow. Now, I know what you're thinking, that when are we required to adjust them in the cash flow statements? How is it concerned with the cash flow statement? Just bear with me for a while. We'll see how this is factored in the cash flow statement. An increase in liabilities is your cash inflow. Why? Because let's take an example here, year 1 and year 2. Your, let's say, inventories. Year 1 it was 100, year 2 it becomes 120. So this change of 20 is your outflow. How? Because now you have more cash that is tied up in your inventories. So if your inventories increase from 100 to 120, more of your cash is getting tied up in those inventories. Yes, so you have less liquid cash available with you. Hence, it is regarded as an outflow. Whereas, if your creditors increased from 100 to 120. That means what? You are delaying the payments to the creditors. That means you have more cash available with you in the company, more liquid cash. You haven't paid to the creditors yet. And hence, this is regarded as an inflow. Alright, so please keep this concept in mind. That's a very, very important concept as far as cash flow statement is considered. Now, cash flows during the period that you generate can be divided into three different items or three different heads. Cash flows from operating activities, cash flows from investing activities, and cash flows from financing activities. So operating activities is basically your day-to-day operations. Alright. Investing activities is basically the acquisition and disposal of your long-term assets. Anything related to non-current assets. Anything related to your property, plant, equipment, furnitures. You sell the furniture. You are making capital expenditure into the company. That will be shown under investing activities. Now, cash flows from financing activities. These are the results from the basically you can say borrowings or the equity component. You pay dividends, you raise bank loan, you repay the bank loan, you raise equity capital. All these will be shown under financing activities. Okay, I hope this is clear. So let's move forward. Yes, that's the format of the cash flow statement now. You start with the net income, you add back depreciation and all the non-cash expenses. You add back depreciation, non-cash expenses. Then these are the working capital changes. Decrease in accounts receivable. If your assets, so what I told you a while ago was, if the assets increase, that's an outflow. If it's an outflow, you subtract in the cash flow statement. On the other hand, if the assets reduce, then what? Then it's an inflow. Hence, you will add in the cash flow statement. Alright, so increase in liabilities, you add. Increase in inventory, you subtract. Then gain on sale of equipment, that's fine. So cash flows from operating activities, then equipment purchased, equipment sold. So this is your capital expenditure and sale of assets. Then financing activities, alright, and it ends with the ending balance of cash, which is then taken to your balance sheet. Okay, so that is the flow of the cash flow statement. Well, I know it was kind of theory that we have covered, but I hope this is very, very clear, guys. So apart from these three components, you also make statement of changes in equity. We have not covered it here. Why? Because we are focusing more towards financial modeling. We don't make that statement as far as financial models are considered. But yes, that's an accounting statement requirement that you have to make that statement also. Okay, that was one. Another thing is notes to accounts. How are notes prepared? For every item that you show on your financial statements, there is a separate note attached to it. Note means it has the workings. How is that amount which you have shown in the financial statements that has been arrived at? All right. So you show that in the form of notes to accounts, in the form of workings. We'll see that once we move on to the financial modeling. What we'll do after this video is, now that you have understood the financial statement theoretically, what we are going to do is, we will do a case study. We will do a case study. In this case study, you will have various inputs. All right, you will have various inputs. From those inputs, we will prepare financial statements in Excel. We'll see how different components are related, how are they are computed, and how do we arrive at the balance sheet. All right. So we are going to prepare those financial statements in Excel from those inputs. This will also form the basis of your financial modeling. We'll see how. So this is a very, very important case study, guys, that we are going to do. We'll be having a set of inputs. From those inputs, we'll prepare financial statements, and the procedure that we apply, the way that we prepare those financial statements, it will form a basis of your financial modeling. So I'll see you around in the next video, guys. I know it was kind of a theory thing that we have covered, but it was very, very important for me to cover it here before we actually put our hands on Excel. Well, time to roll up our sleeves and start the Excel workings for case study. I'll see you around in the next video, guys. Please move forward only when you are 100% comfortable with all the aspects that we have covered in the video. I'll see you around. All the very best.